Hi everyone. Wanted to do a problem in chapter 12. So first of all, congratulations to getting to the end. Hopefully you found chapter 12 to be pretty straightforward. It is really not a repeat, I would say, but a collection of all the ratio work we've been doing each chapter, all in one chapter. And there are a few things like trend percentages that are a new concepts to it, and we'll work through some of those here. So the problem I wanted to work through is P1256A, and this is on page 722 in the book. So feel free to pause the video and go review that problem and the questions and all that good stuff. So I'm going to get started here with requirement 1, which is calculate trend percentages for each item for 2015 through 2018. We're going to use 2014 as the base year. So really what I'm going to do here is I'm going to look at each thing. In fact, you know what? Let me create a table. This is going to be 4 by 6. And so this is net revenues, net income, total assets. And so the years we're doing is 2018, 2017, 2016, 2015, 2014. And so 2014, they told us, is the base year. That means 2014 is going to be 100% for each year. And each subsequent year, 2015 and going on, is simply going to be the value in 2015, so in this case 315, divided by the value in 2014, 296, which is equal to 106%. And if I repeat that for these other line items, whoops, that's what I get. And so 2016, same thing, you're just going to be dividing what the value is in here by the value for 2014. And so you'll see that I get 119% here and 112% here, 122% here. And I'm going to continue that for 2017 and 2018. So if you do that, if you do the math, this is what you should be getting. So again, trend percentages, it's all relative to the base year. And in this case, they told us the base year is 2014. Okay, so hopefully that's pretty straightforward. Requirement 2, they want us to calculate the rate of return on net sales for 2016, 2017, and 2018, and round to the nearest 3 places, right? And so, and also explain what it means. So first, return on net sales is just your net income divided by your net sales. So for 2018, this equals 30 divided by 498 for 20, or which according to my math is 6%. 2017 is $10 divided by 327, and 2016 is $28 divided by 352, which is equal to 8.0%, okay? What does it mean? It's really measuring the amount of net income for each dollar of net sales that you are getting, right? So if I sell $1 worth of stuff, how much of that dollar is actually net income, or how much of it goes to my bottom line? So you can see that the trend has been, it was 8% in 2016, dropped all the way down to 3.1% in 2017, recovered part of the way in 2018, but not the whole way. For requirement 3, they want us to calculate asset turnover. And asset turnover is going to be net sales divided by your average total assets. Okay, so I'm going to calculate the average here on the screen for 2018 to show you the math, but then I've done the averages below already here on a separate sheet of paper for myself. So I'm going to do for 2018, I'll do the entire step-by-step process, and then you'll just repeat the same thing for 2017 and 2016. So for 2018, my net sales are 498, right? And my average total assets are 266 plus 314. So beginning plus ending total assets divided by 2. That's how I'm going to calculate the average, right? And I'm going to do this math. So here's the equation, right? And what is that going to equal? That equals 1.72. So I'm going to do the same thing for 2017, which is equal to 327. And I've already done the average here, which comes out to 257 for average total assets. Okay, and that's going to come out to 1.27. And then for 2016, I'm going to do 352 divided by 236, which is equal to 1.49. Okay. So what does this mean, this 1.49, 1.27, 1.72? It really means the amount of net sales per dollar that's invested in assets, right? So the higher sales that I can get over average total assets, the more efficient the firm is, or low cost, let's call it, right? So the best real world example I can give you is, think about running an Uber business or Lyft. Would you rather have $1,000 worth of sales with one car or 5 cars? Well, you'd rather have it with one car, right? It's more efficient than managing 5 cars to get the same amount of sales. So that's the advantage there. So requirement 4 asks for using DuPont analysis to calculate the rate of return on average total assets for 2016 through 2018. Okay, and so for DuPont analysis, I'm going to take my asset turnover, which I calculated, and I'm going to multiply it times my return on sales, which I also calculated. So for 2018, I'm just going back up here. So 2018, I'm going to take the 6% and I'm going to take the 1.72. So 6% times 1.72, and that gives me a 10.3% return on assets. Okay. So 2017, I'll do the same math, 1.27 times 3.1%, which is equal to 3.9%. And 2016, I'll do the same thing, which is 8% times 1.49, which is equal to 11.9%. So requirement 5, how does the return on net sales for 2018 compare with previous years? How does it compare with that of the industry? So in the shipping industry, rates above 9% are considered good, and above 11% are considered outstanding. If I look at the return on net sales, it went from 8% to 3.1% back up to 6%. That's below the 9% for the industry average, right? And below the 11% for outstanding companies. So if I compare this to the industry and other companies, clearly they're not doing that well. In requirement 6, they say, what about the return on assets for 2018? How do you compare that against an 18% industry benchmark? Well, again, it doesn't look good compared to an 18% industry benchmark. You go from 11.9% to 3.9% to 10.3%, which is still well below the industry benchmark. So, and that's the biggest value add really out of this subject is, can you use do analysis and use your results to make some decisions and make some conclusions around which companies you should lend to, which companies you should invest in, and such. So good luck making it through the course. I hope this was helpful. Again, hopefully chapter 12 is not too bad, and best of luck in future endeavors.